Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 30 minutes here on Options Guide TV. Today's date is Friday, May 3rd. It is the Friday before the Berkshire Hathaway meeting on Saturday, and I got to admit that I will have CNBC tuned in. And I will be following the event because it's a huge event in this day and age. So it's always interesting, the legend, the goat, if you will, of investing. Uh, Always the fact that he has just stayed so involved in Berkshire Hathaway. And I have a little anecdote that I want to share with you at the end of the show, but the stock is just amazing, and a lot of the financial networks just don't even cover it in this day and age. They very rarely talk about it until the shareholders meeting comes around and stuff like that. But the stock still is just, it's not even one of the Mag Sevens, but it's outperformed a lot of the stocks in the marketplace, and it continues to just go up. So Warren Buffett has definitely made a lot of millionaires in the Omaha area, without a doubt. Just his presence, and it's going to be an interesting little show that will be going on Saturday all day long. It kicks off about 9:30 Eastern time. And he is supposedly going to answer questions for up to 5 hours at some point in time during the show. So very impressive person in general, and I definitely will be tuning in for the show. Now, this week, I just got back from the Options Industry Council in Asheville, North Carolina, which isn't that far away from me, a couple-hour drive up a mountain. And well, a lot of good things came from the event. It's always great. It's amazing. I always say, especially in the options trading world, the faces don't change and the names don't change except for on the business cards. So there's a lot of movement amongst firms, but the same people always seem to be attending, and I love that fact. It's one of the things I love about going to that conference after being in the option trading world for 30 plus years. And the big topics were 24-hour trading in the options trading world, and then also zero DTE, the expansion of zero DTE into single stock names. And I'm actually kind of opposed to it, and I'll give a little bit of rationale behind why. I mean, one of the things that has happened in the marketplace, in particular over the last 10 years, let's say, with the advent of just faster computing, the ability to quote more quotes, because in the options trading world for many years, it was hard to have one stock like IBM and then put out, 400 quotes every second on IBM on option contracts, because that's how many contracts were available. So when the computing power stepped up, that allowed the exchanges to change up the way that they do things. They added more strikes, they added more expirations, and the weekly expirations were a huge hit. And now the zero DTE expirations are a very huge hit. And as a matter of fact, it has helped increase volumes on the exchanges year in and year out. It seems the Chicago Board Option Exchange and all the other Chicago Board Option Exchange is now called the CBOE Global Markets is what it's called. It's no longer the name that of the company that of the exchange that I used to work for. But with that said, every year they're still setting record volumes as far as option trading. And a lot of it has to do with the fact that people just have more access to the data. They have more access to the education. They have more access to important things like delta inside an options chain. They have profit and loss calculators, or what we call inside the TradeHawk software and use all the time as the what if calculator. What if the stock goes here? What would happen with our option strategy? So these tools have made option trading a little bit more exciting. Now, if we ever get down to single stock names, there's obviously the Meg 7. They're always going to have very good volumes, very good markets in the option trading world, and maybe they can support the zero DTE expirations. And I'm sure that they would be popular. Now, when you get away from the Meg 7, let's look at stocks like Disney, Caterpillar, Walmart, like extremely good stocks that are still extremely liquid. But when you get to the minutia of the option trading world, there was a reason why the original um, uh, founders, I guess, of the options trading world. I'm not really sure what word I should use, but there's a reason why they limited the number of expirations and the number of strikes, and that there were rules around it. And that's because they didn't want to have too many offerings, too many quotes out there, and vehicles to trade, that the bid ask spreads would get too wide. They wouldn't be tight enough. They wouldn't be liquid enough. And I fear that if we start getting to zero DTE on single names, that it's going to hurt stocks. It's going to hurt some of the stocks that have really good volume, really good options markets, and there's just going to be too many offerings available. Because I don't always want to trade. I don't want to trade zero DTE in Walmart. I don't have a need to trade that. I can understand it in the S&P 500 index. I could even see it in the VIX index. I like trading the VIX, and I don't mind speculating on a one-day move in the VIX at all. But on a lot of these contracts, on these not super liquid, not amazingly liquid stocks, right? I worry that if we keep going down this path, that we're going to go back to wider and wider bid-ask spreads. And that's a concern of mine. 24-hour trading, I don't foresee it happening. And that was really the word that I received at the Options Industry Council, that 24-hour trading in the options marketplace isn't going to happen anytime soon. Also, individually listed zero DTE option contracts on individual stocks, that doesn't look like that's going to happen anytime soon. But they're going to continue to expand their offerings in ETFs and also in the major indexes. And I'm okay with that. It's driven some options volume. It does make things interesting, how you can manipulate a strategy. And we do that a lot on Options Guy TV here in the S&P 500 index. So I like it in that index. I just don't like it for all things across the board. That simple. Okay, so we had a really interesting trade in the S&P 500 index, and we did roll it on Wednesday's show. So path of least resistance, we said on Monday, would probably be to the upside. The market, and we're talking about a 1-week trade, well, the market decided to go down on Tuesday. And so on Wednesday, I was actually at the conference. We said, I don't know if we would adjust on this, but let's adjust the trade, because one of the biggest things about learning about options, it's pretty easy if you're correct on your forecast to know what to do. But what do you do when the market goes against you? So we set up a trade on Monday that was a 5-point wide spread. And I did talk about the fact that I would normally do a 10-point wide spread in my own account, but we wanted to keep the risk fairly low when we first put on the trade. And we were bullish on the marketplace, hoping to get the market to go up 20 points. And what ended up happening, it went down 20 points. It went down. As a matter of fact, I have the number. It went down. When we looked at adjusting the trade, we were down 18 points on the market at that point in time. The S&P 500 index was for that day on Wednesday. So here's the trade. And it's really interesting because we are right within the sweet spot of the trade. So we went, and on Monday, we bought the 51.05 with the May 3rd expiration, this Friday expiration. And you notice we're right at that strike right now. and we sold the 5110. So it's very odd that it would be right here while we're taping the show. So don't get this opportunity that often. And that was our long call spread. Market went down. We put it on at that point in time. We put it on for $2.80. And the market was right at 5110. Market went down. We rolled it. We moved it into a butterfly that was equal with the part. And this is part of the reason why, and I mentioned it on Wednesday's show, why I like to do a 10-point wide 10-point wide spread in the S&P 500 index, mainly because when you roll into a butterfly, you're going to have a little bit wider butterfly, a little bit wider landing area if you have to. If you're wrong on your forecast, the market goes down and goes against you. So we did 5 points, and I'm just going to leave it there. I don't want to keep talking about it because I've mentioned it on Monday and on Wednesday's show. So at 5105 is what we bought, and we're showing this right now, right? Yep. And then we sold the 5110. Now that's trading for $2.50. The market is right at 5105, but guess what? We were all the way up to 5110. We still have a little bit of time left. So we came back, and then I'm going to just remove this leg. So remember, this was the position we had on paper. That was our paper trade. And so I'm going to remove this leg. And what we ended up doing then is selling another 5110 and buying the 5115. And when we did that, 5110, 5115, okay. And when we did that trade, we brought in a net credit of $1. So we paid $2.80. We reduced the cost to $1.80. Said we still got a chance that the market could come back and pay us out on the upside. And then that left us in the butterfly position. So here was the butterfly, 2 and 3. And right now that's trading for 40 cents. So in this morning, when the market was closer to 5110, which it was, it touched 5110 not that long ago. Now it's at 5103. This was trading for about $1, and we almost accomplished our goal of being able to get out at break even. So I would have gotten out. When it hit 5110, I would have gotten out today. Right now, it's trading for 40 cents, so you can still salvage something. So once again, the adjustment is I don't want the cheese anymore. Just let me out of the trap. So that's what I call this adjustment. Market went down. And I'm like, all right, the market's going pretty hard against me. I want to adjust it. I'm going to sell this spread. I'm going to stay in the position as opposed to just closing out the long call spread. And hopefully the market comes back. And it did. It came back, and now it's sitting right at our strike. And there's still a good chance that it could come back up. It's at 40-cent net debit right in the middle. So that's about where we could sell it at. And if you wanted to play the risk game, like let's see if it lands somewhere between 5105 and 5115, and it lands somewhere in that range. Well, SPX options are cash settled. So all that would happen is cash would come into your account. The maximum it could trade for is $5. The width between the strike between 5110 and 5105. If it stopped right at 5110, the max it would trade for is $5. So if you can get $2.50, you're definitely going to take that and get out, and you would actually be profitable on this trade before it was all said and done. So very interesting that we actually did have it come back and actually on Friday's expiration touch our short strike. That's just dumb luck. But with that said, it was the right thing to do. It was the right adjustment. We said that we were more bullish than bearish. Got once again a slew of economic data. We still have a lot of companies that are going to be announcing earnings, but I'd say about 50% of the S&P 500 index has announced. We still have Nvidia coming out and at the end of May, so they're the last of the Magnificent Seven to actually announce earnings. And everything started with Netflix. So we've had more good earnings on the mega cap tech stocks than bad. Meta got beat up a little bit, but it's bouncing back a little. And just in general, a lot of economic data, volatile times. We're seeing the VIX coming back down to around that 14 level. So, a very interesting trade, very interesting adjustment. And we ended up doing fairly well on the trade that we were down on almost instantly from the first time that we put it on in that market. Okay, so now the other trade that we looked at for the week, and let me pull that one up, is we looked at Amazon, and we actually closed out Amazon on Wednesday. So let me pull up the Amazon stock right now. So we did something different. We did a ratio spread before they announced earnings on Tuesday, which Amazon almost always announces on a Thursday, but they picked Tuesday this time around. For many, many years, they announced on a Thursday, but they announced on a Tuesday, and we did a ratio volatility spread, hoping to get a big move to the upside. We got a slow move to the upside. It took a while to get momentum to the upside. So on Wednesday, we put the trade on for a net credit of $1. We were able to take it off for a net debit of 90 cents, and we made a dime. And it turns out to be the correct move in that the market is at 186 right now. And that was right at the horrible spot as far as our strike is concerned. So let me pull up my screenshot of that. So 182, 182.50 to 192.50. So we're right in between those strikes. And as a matter of fact, let's back out a little bit here, and I'm gonna move and talk a little bit about this graphic that I just decided that I'm going to show you. So pull that down, pull this up. Okay, so here's where the danger zone is on our Amazon trade. So we put the Amazon trade on, net credit of $1. Solid means if the market went down, we're going to make $1. Totally fine with that scenario. Also said that this is our risk. The green line was our risk. You don't have a lot of risk until you get close to the end of the week, and the market, if implied volatilities come down, you start getting some time decay. So right now, Amazon is right in this trough. It's hanging right in here. We closed out the trade somewhere around here. The market was somewhere in that range. And that's when we took the trade off and got out of it for $1 on Wednesday's show. We actually talked about it right during the show. And now we're kind of in trouble. So what we wanted to happen was we wanted them to announce earnings, and we wanted them to do which Apple even did this time around. Take a strong move to the upside. And Apple usually doesn't have that type of volatility, but yeah, right. Even today, it's up. Well, it was up $5 at that point in time when we did that trade, and the stock is up strong. It's moving more than the one standard deviation move, and that's what we were hoping that would happen in Amazon, and it didn't. So we got out at the right time on that trade and made a dime, or basically broke even on the trade. Then let's go back to the big, yeah, right there. I like that. Let's stay where we're at, and we're going to then look at I got a little bit of an anecdote that I want to share with you. So I'm going to pull up something here. We mentioned the Berkshire Hathaway, and let me pull this up. And here you go. Okay, so let's go back to this view, and I just wanted to show you this chart of Berkshire Hathaway, and I do have a story to tell you, and this is a true story. And it deals, and I have to give kudos to a longtime friend of mine who has passed quite some time ago. May he rest in peace. His name is Joe Heed, one of my first mentors in the brokerage industry. I was very young way back in the day when I worked with Joe. We were at Charles Schwab before you could actually place a trade in via the internet. Schwab was one of the last companies to adopt that. They were the stock was, they were a darling of the stock market. The phones were extremely busy. You had to call to place any type of trade that you wanted to place. But I had saved up approximately $10,000, and I was about 24 at that point in time. And I'm from northern Wisconsin. My father was a guidance counselor and a baseball and basketball coach at our high school and all that. So I was never really around a lot of money when I was younger. And so I was all set. I actually remember I had a CD that came due that I had in a bank account, and interest rates were right around 4% at that point in time. Back in 92 it was. So I'm really dating myself. But I was trying to find some stocks. And I remember talking to Joe Heed on the desk. He was still working in his 60s because he had like 10 kids, and he had one more kid that he was paying for in college. So he was in the basically doing the same job I was. Very intelligent person. I remember he used to always just read the dictionary while he was sitting at his desk, and that was one of his favorite things to do to pass the time. And I was going to buy, I wanted to buy 100 shares, like a lot of people. They think they need to buy 100 shares of an underlying stock. And so I thought I was going to pick a few of these stocks and take $10,000 and be able to buy, 100 shares of all three of the stocks, if I remember right. I don't even remember the stocks that we were talking about. And I remember Joe saying to me, he goes, forget those stocks. And he said, you should buy this company. And then guess what that company was? Berkshire Hathaway. And the stock at that time was trading close to $10,000. So I remember I could buy one share of stock with the money that I had. So it must have been right around in here. Yeah, it's 91, 92. Right after I graduated college, I was probably 23 or 24 years old. And he said, do not buy those companies. He goes, just buy Berkshire Hathaway. And we kept up many years, many different jobs, moved forward. I started specializing in options and yada, yada, yada. But here's where Berkshire Hathaway Class A is right now. So if I would have bought the one share, I definitely wouldn't have held it this entire time. But that one share of stock in my 20s would have be worth, at one point in time, $630,000. And it's interesting because the stock has never split in Berkshire's case. So they now have a Berkshire Class B, which I do own in my retirement account. But yeah, so I thought that was a fun story that I would share. If you have any comments or, money stories, I will never forget this. And this stock has haunted me my entire life because whatever I ended up buying way back then, and I would love to go back and see that. I actually still have that Schwab account. I doubt I can get that information though. But that's where I place the trades. I would always keep quoting this stock all through the years. Like even so, the stock was very volatile at that time. If you see that this is obviously a weekly chart. But then in 1995, a couple of years later, it started to take off. And then from 2000 to 2005, it went up to 80,000. Then all of a sudden it's above 100,000. So I have to say that the fact that I never bought that stock on that day from a man that I really respected, saying that you should not buy these piece of junk $20, $30 stocks, and you should buy one share of this $10,000 stock. I think that's interesting. So hence the reason why I always like to watch the stockholders meeting for Berkshire Hathaway. I've always found this company to be amazing. All right. If you have any questions, I don't have a trade for the day this week. Next week, we do still have some big companies that are going to be announcing earnings. Ones that I'm keeping my eye on is we have Disney Tuesday morning. They're going to announce earnings. So we'll probably look at a trade in Disney. Why not? Right? We'd like to do that on Options Guy TV. So we'll look something around earnings. And also BP will be announcing that morning too, along with Disney. Monday morning, we actually have Spirit Airlines. Symbol is SAVE. It's a $3 stock. I'm just kind of interesting. Uh, they're struggling a little bit. Interesting to see what they're saying about where they're going with travel and the economy a little bit, just to try to see where their numbers are at. And then we have Robinhood on Wednesday. We also have Uber on Wednesday. Lyft is going to be announcing on Tuesday. I did see that one too. And so there you have it. We're going to have still some stocks that we'll be able to look at some strategies on. We'll come back on Monday. Real good economic. Actually, that had as far as jobs are concerned, a lot of people were saying Goldilocks numbers, exactly what the Fed wanted to see. Not too good, not too bad. So the market, I expect to continue to rally into the end. I do not want to put in a skip strike butterfly today, which would be our normal trade if we were going to put something in on a Wednesday. We'll come back on Monday and we'll do our weekly S&P 500 index trade. And let me see. Do we have? We have a comment. All right. Let's go ahead and toss it out there. Wayne. All right. Hey, Wayne. How you doing? Do you think zero DTE trading is creating more of a gambling mentality for traders, or are traders doing good with them? Option traders in general, throughout the years, the most volume has always been on the at the money option contracts. And part of the reason why is that they have the highest gamma. They move the most. So a lot of option traders want to see some type of movement so that they can react upon it. And you're going to get the most explosive option contracts when you're talking about a day away from expiration. And I have done this many times on Options Guide TV and a lot of my shows. Don't necessarily trade earnings nonstop. That's not the concept of trading options all the time. But you learn a lot about looking at how option prices move after an earnings report. And so zero DTE gives them that excitement. Do I think that most people are abusing it? I think in general, I've seen more good than bad. I'm sure that it goes both ways, Wayne. I'm sure that there are a lot of people out there that are just buying out of the money calls. And then that's a real tough gig, by the way. If you're going for one day, one trading day, and you are buying an option contract and you're doing it directionally and you're buying out of the money calls and out of the money puts, that's just a real hard way to make a living. But I've seen a lot of people adapt to trades that we talk about all the time from the options playbook, like iron condors, like zero DT butterflies. And so if you're on a lot of those strategies, the ability to do a one-day option contract is very interesting. So, and I've seen a lot of retail customers morph towards that. So I think that's good. I think it's good to have that. I just don't want it to flood the markets and hurt the liquidity of the marketplace, because there's so many different products that are being introduced across the boards. I was never a big fan of the minis when they came out. From day one, I didn't really think that they would make it, and they just haven't, and they keep trying to reinvent the wheel, and just don't think that that's a thing. If anything, I'd like to see the biggies, if you could. I would like to see take a lower price stock and times it by 10 and make it a high price stock, because then you're turning a stock like Walmart into a high priced option contract that has a much different dynamic than a medium priced option contract. And those are the ones that I used to love Amazon when it was over $1,000. So it was very fun to trade. And a lot of those stocks that did that. I don't mind that they did the split, but it was much more interesting dynamic pricing wise when you had $1,000 stock as opposed to $100 stock. All right. Any other questions? No. All right. Well, that's it for this week. of Options Guy TV. We don't have a trade to look at over the weekend. There's going to be a lot going on the weekend. Usually, I would expect maybe the market to bounce after Berkshire Hathaway comments. Is just usually a good feeling after their big event. But on Monday, we'll look at a new trade in the S&P 500 index, and we'll talk about some of the companies that are announcing earnings and look at a few strategies that way. And then eventually we're going to get back to our paper trading portfolio of deep in the money call options and make some of those adjustments now that a lot of those companies have announced earnings. Thanks for coming. If you're on the Tradier YouTube platform, click subscribe, ring the bell, get all the alerts. Hopefully you're watching me a little bit on Twitter and x.com. And we're now streaming that live, and we're going to be looking at a lot of different venues to show off, if you will, Options Guy TV. Thanks for coming, and we'll see you Monday.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.